All right, good morning, everyone. Thanks for joining us for the webinar series of Frost Law on the Employee Retention Credit. Quick word from our sponsor. As a community bank of the nation's capital, United Bank is proud to be a sponsor of this What's Up Media webinar series. United Bank has been serving the greater Washington, D.C. region for over 30 years, providing a testament to their continued stability and reinforcing their position as a reliable banking partner. Backed by a history of safe, sound, and secure banking practices, United has navigated changing economic environments while staying true to their mission of excellence and service to their employees, customers, shareholders, and communities. They have the technology, products, and expertise that you expect from a big bank, but with the personal touch and local financial decision-making only a community bank could offer. They are proud to be the bankers you know and trust. For more information, visit bankwithunited.com. And just a reminder, if you have any questions, feel free to put them in the chat box or the question box. And I'll turn it over to Frost now.
Thank you, August. Thanks so much for having us today. I think this kind of closes our series on the employee retention credit. Ignore my typo in the beginning. It was my job to update the slides. The date is right, it's June 14th. So this is employee retention credit for medical professionals. So doctors, dentists, chiropractor, whoever, whatever your practice may be. Just to give a little bit of background about me and Peter, we were tax attorneys up through March of 2020. That's all we did is work for our clients doing tax controversy matters. So what that means is that our clients were kind of on the bubble of viability, small businesses, that something would happen, someone would get sick, equipment would break down, and the business was not able to pay its sales tax, payroll tax, income tax, what have you. Then March 13th, 2020 occurred, and we knew we had to dig deep into the CARES Act to figure out how to help our clients survive this pandemic and how to make sure that they would be able to withstand and come through and be able to continue operating. So Peter and I did, and we first started with PPP. That made the most sense. In the origination of the CARES Act, you couldn't use the employee retention credit or PPP at the same time. So if you took PPP, you were ineligible to claim the employee retention credit. At that time, the employee retention credit maxed out at $5,000 and PPP maxed out at $15,000. So it only made sense to work on the one that was $15,000. So that's what we did. We helped our clients navigate that process. And, as I'm sure you're all aware, that process changed about 122 times between, April 2020 when it was enacted to, December 27th, 2020 when new legislation was signed into law. Each iteration of PPP with guidance and legislation came better results for the business owner. So at first you could only use the PPP money in that little bubble of 8 weeks. And then it got better and better and better, and you could use it for 24 weeks. And similarly, and Peter will get into this in more detail, in December of 2020, the legislators realized that though they tried to shut the economy off like a light switch and just turn it right back on, that was not what was happening. And businesses were still struggling. And they allowed businesses to take the ERC at the same time as PPP. So it really worked out well for the business owner. And that's when we started shifting our attention to the employee retention credit. We'll go through those credits and Peter will explain the legislative history behind it. But just to give you kind of a background is that we came through this process, very organically in order to help our clients that were tax controversy clients. And, at that point, once we realized what the credit was able to do, we could kind of pivot to more viable businesses like yourselves and help you navigate this process. So I'll give it to Peter.
So before we get into details, just recap all the stuff that was out there in the CARES Act and subsequent legislation. There was Paycheck Protection Program, PPP. There was Family First Coronavirus Response Act, FFCRA. That was a situation where you could receive a credit for paying wages to someone who was sick with COVID or caring for a close family member who contracted the disease. There was a deferral of employment tax payments where, you know, half was due December 31st, 2021, half is due December 31st, 2022. There was the employee retention credit that nobody was really paying attention to, again, because PPP was way more lucrative. There was the restaurant revitalization fund, there's shuttered venue operators grant, and then there was the EIDL loans, the economic injury disaster loan, where basically the president said, every place in America is a disaster zone, and that opened up the opportunity to get some really favorable terms. ERC legislation, it all started with the CARES Act. That was March 27th of 2020. And everybody, again, was paying attention to PPP. December 27th, 2020, the Relief Act comes and they say, okay, just kidding, you actually can do both PPP and ERC. We'll get into, you know, how those, you know, interact with each other a little bit later. But not only did they say, you know, you can get both, but now you can actually get quarters 1 and 2 in 2021 as well, and it's easier to get and more lucrative. Then change of administration happens. American Rescue Plan comes March 11th of 2021, says, okay, now you can get it for quarters 3 and 4 of 2021. And then just to keep everybody on their toes, the Infrastructure Investment and Jobs Act in November of 2021 said, hey, just kidding. You actually can't get it for Q4 in most circumstances. There's some exceptions that we'll work through. Guidance was coming fast and thick with PPP. ERC, it's been a little bit more muted. There's 4 notices that are particularly on point. Primarily 2021-20. There's been some revenue procedures that have come out as well. But these are really the basis for this presentation and really everything we know about ERC and how it works in addition to the legislation. And then just so you guys know where we're at, PPP was, you know, built on an existing 7A program through the SBA. And you worked through your banks and you applied to your bank for the loan, you applied to the bank for forgiveness. This is different. This is, you know, solely within, you know, IRS world, and it's built on top of, you know, existing payroll tax stuff. And, you know, payroll tax basics, just you are filing a quarterly Form 941 where you're self-assessing, you know, FICA taxes, which is Social Security and Medicare, and also, you know, identifying how much you should be withholding for employee wages. That's what's going on here. It is built on top of those Forms 941 and the existing employment tax structure. So that's where we're at, and the mechanics of it we'll get into a little bit further.
What are we talking about? What is this credit? The employee retention credit is, this is the legislation that goes through, but it's a refundable credit. So what that means is a check that's made out to the business for each quarter that you're eligible, and you have free reign to spend it however you like. So PPP, you could spend it on wages and utility payments and things like that. RRF is like you can buy food and other things. This is, once you've gotten it, it's income, which you have to pay taxes on, but you can spend it however you wish. You can take a distribution out of your business and pay yourself. That's absolutely fine. So what is it? For 2020, an eligible employer is allowed a credit against applicable employment taxes equal to 50% of the qualified wages, up to $10,000 for the entire year. For 2021, an eligible employer is allowed a credit against applicable employment taxes for each calendar quarter, amount equal to 70% of the qualified wages, up to $10,000. So this kind of tracks with exactly what, you know, Peter and I have been saying, is that as legislation continued to come out, it got more and more favorable for the business. So at first it's 50% of 10 grand in wages, so 5,000 per employee. And then for 2021, it's $7,000 per employee per quarter. So up to $21,000, assuming you're not, you know, a recovery startup business, and we can talk about that at a different time. But that's a max credit of $26,000 per employee. That adds up very quickly. You know, Peter and I have had cases where we've had small, you know, small credits $25,000, things like that. But we've also had cases where, it's like, and lots of cases where clients are getting more than $1 million back based on the employee retention credit. So it's been really a godsend to them. To the next.
Real quick, if I can just jump in. It's based on wages paid, and it's this weird, like, you're getting a refund of taxes paid. That's what's, like, the important thing is the qualified wages, and it's up to 10,000, and the 50% and 70% is really just calculating the tax credit that you're getting. That's where the numbers come from.
Right. So you're going to get more money back than you paid.
Yeah.
Which is weird. But essentially, during the CARES Act, what Congress needed to do was figure out ways based on already existing systems to get people money as quickly as possible. And like Peter said, PPP was built on SBA. This is built on, already like the Treasury and their structure and giving refunds and being able to issue checks. They just needed to figure out how to do it to keep people off unemployment. So who's an eligible employer? How do you get it? So we told you what it is. $26,000 per employee is the max. How do you get there? An eligible employer is an employer which is carrying on a trade or business during the calendar quarter for which the credit is determined. You went too fast. I didn't get to do my whole and.
Yeah, sorry.
And there's two ways to qualify. There's a gross receipts test and a partial restriction test. Method one is the gross receipts test. It's the easiest one. You do this first, because if you qualify with gross receipts, you don't have to do anything else. So for 2020, the gross receipts decline that the business needs to show is that the gross receipts have gone down 50% quarter over quarter comparing to 2019. So for most businesses, this is going to be a Q2 where that's going to be the best case scenario for you if you had to close for 8 weeks or whatever the reason. For 2021, it got better. The legislation is more friendly. And instead of going 50% down, all you need to do is go down 20% of revenue decline compared to 2019. That's your base year that you're looking at. Now, there are alternative reference periods for 2021 that allows for automatic qualification. What that means is if your Q1 revenue went down 20% and your Q2 revenue went up 90%, you're still eligible for Q2 based on Q1. So it really is favorable to the business owner. And one thing that's important to understand with the gross receipts test is that this is not tied to any COVID reasons. Your gross receipts went down because you closed a location. Your gross receipts went down because you lost a doctor in your practice. It doesn't matter what the reason is. It doesn't have to be related to COVID. Now the next test does. The next test is full or partial suspension. So what that means is that the government shut down either your business completely or a portion of your business. So the operation of the trade or business is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings for commercial, social, religious, or other purposes due to the coronavirus disease 2019. So again, this is tied to COVID and tied to a government order. So the government came in and it's like eminent domain and said, hey, you can't operate because you have mostly elective surgeries, or you're not able to treat people in the way that you had done previously because it's not an emergency. It's not part of the public health. It's not essential. Or you can keep your office open, but you can't do XYZ treatments because they are not essential. So that would be a partial suspension. And that's mostly what we're talking about today, is that partial suspension. That's kind of where we've found we can provide the most value in determining eligibility for companies. So in order to be partially suspended, you need to have more than a nominal portion of your business that is shut down due to a government order. The government views the nominal percentage to be 10% of your business, the way it was in 2019, either in hours worked or in revenue. So for example, if you're a doctor's office and you were not allowed to see certain types of patients because it didn't deem to be essential. And that was more than 10% of your revenue stream in 2019 in that quarter, then you're eligible. Not that portion of your business is eligible, but the entire business is eligible. So governmental orders throughout the country restricted many doctor, dentist, and chiropractic offices from attending the same number of patients as they were able to in 2019. Whether restrictions were based on capacity in the office, canceling of elective surgeries, or enhanced cleaning procedures that directly caused a reduction in treating patients. There are lots of different ways medical professionals may be eligible for the credit, and certainly worth discussing, further to see if we can get you there regarding eligibility.
Well, and we've worked with dentists who couldn't do, routine cleanings. We've had situations where you've had to do enhanced cleaning between clients, and pre-pandemic, maybe you saw 100 people a day, and because you had to spend time doing these enhanced cleanings, you're only able to see a fraction of that. These are the types of issues that we're talking about, and trying to say, hey, slow up, think through these things. You might actually be eligible.
And what we found, and this is not to disparage any CPAs or accountants, but what we found is due to the amount, the sheer volume of orders and guidance and all that stuff with PPP, CPAs just kind of burned out, tapped out, and we're done. And they never really caught up with, or at least for some, didn't catch up with the legislation that came through in December of 20, saying you could use PPP together, that discussed partial suspension, these notices that came out, where there's a lot of examples of restaurants. Restaurants are kind of an easy business to understand that, dining rooms were limited with capacity. That's going to limit their revenue. And in 2019, most likely their revenue had more than 10% based on indoor dining. But medical offices can similarly be eligible based on capacity restrictions and Peter was saying about cleanings and other things. And so I would just say, if somebody told you before that you weren't eligible for this, it's worth taking a second look. Usually what happens is the CPA gets on the phone with us, we explain our thought, and everyone's good and moves forward. I haven't had a situation where I haven't convinced the CPA that we were right. There is a question in the chat. Does HHS funding add into gross receipts?
Does what funding?
HHS, I'm assuming Health and Human Services funding. I think that's going to be it depends. If it's a grant that you received, possibly not. But if it's them paying for services, then I would say yes. But that's we can look at it.
Generally speaking, gross receipts are governed by Section 448, and it's the only times that you would back something out would be related to a refund or an allowance. Otherwise, it's going to be your top line number for a gross receipts test.
Okay, there's another question, and then we'll get into recovery startup. When you say government order, does it have to be in writing? Yes. So Larry Hogan said, sorry, I changed my orientation weirdly. Larry Hogan issued an order saying, no elective surgeries starting March 16th, 2020 through, and I want to say it was through May of 20 or something like that. That is a government order. The government restricted your ability to operate. It can't be that a hospital decided to be more careful, or you chose because you didn't think that it was wise, you have somebody vulnerable at home, so you close your doors. That can't be why you were partially restricted.
And so to be clear, it's a shall not should analysis. So you've really got to go, and you've got to go out there and find the orders, understand what they say. I mean, we were working with some folks down in Florida who, the way the order was written had to do with more or less a hospital self-certifying that it had more than 15% capacity for beds available to COVID patients. I mean, some of these orders are really tough to work through, but you've got to go, you've got to find the order, make sure that it's a shall not should situation, and that it's not related to a reduction in customer demand or some other thing. It's not a politician making comments at a press conference. It's not recommendations or suggestions. These are governmental orders that typically are statewide, but you can dig down deeper if the locality itself had other other orders out there as well. We get through the question.
I think that's it.
Okay, so we'll have an opportunity to answer other questions at the end, but moving on, there is actually a third way to qualify called a recovery startup business. This was something that was added by the American Rescue Plan. It is only for businesses that began operation after February 15th, 2020. So if you were, there's some nuance here, I think, with you could start a new trade or business within an existing business, after February 15th, 2020. By definition, you had to have an average gross receipts of less than $1 million annually. And you can't qualify under methods 1 or 2. This credit itself is only available for quarters 3 and 4 of 2021, and it's capped at 50,000 per quarter. So it is the only way to qualify for the employee retention credit for Q4 of 2021. And again, it's capped at 100,000 total. But this is a good launching point for just discussing. These are individual analysis for each calendar quarter. So these are forms 941, form 941X that you're filing. Each calendar quarter is its own analysis. So you could qualify under a partial restriction or shutdown for Q2, Q3 of 2020, and then maybe your gross receipts fell in Q4 and Q1, and then now you're in Q3. If you began your practice after February 15th, 2020, you could still qualify as a recovery startup business for quarters 3 and quarter 4. So each tax return, each period is its own analysis. So that up to this point, we've been talking about eligible employer, but just because you're an eligible employer doesn't necessarily mean that you paid any wages that would actually lead to the credit. So what are qualified wages? Generally speaking, it's wages up to $10,000 that you paid for employees. There's some nuance here that has to do with an employee count. And the rule is that if you had more than 100 full-time employees in 2020 or more than 500 employees in 2021, you had to pay the employees not to provide services for the company. In effect, you had to pay them to stay home. Now, it's not a cliff. You could have paid someone both to work and to not work, right? So you could say, I only need you 15 hours a week. You pay them for 15 hours a week. And then because you want to do right by them and they've been with you for a long time, you're still paying the additional 25 hours to get them to their full 40 hours. That 25 hours would still be considered a qualified wage, eligible for the credit. It would only be the part that you paid for them to provide services that wouldn't count. So again, this only matters if you had more than 100 full-time employees in 2020 or more than 500 employees in 2021. So again, they made it easier in 2021 to qualify. And again, this is just a full-time analysis. So it is 30 hours per week or 130 hours per month. This slide is just explaining that it increased to 500 in 2021.
Similarly to everything else, it just got better. So
Yeah, they made it easier for sure. This is you.
I just said it, but it was muted. Limitations and refunds. So the amount of qualified wages credited by the eligible employer for any calendar quarter shall not exceed $10,000. This doesn't pertain to you all, but something to know is that tips are included. So if your spouse or BFF is a restaurant, you don't have to put tips into the wage. You can put tips into that wage amount. So it's money you're getting credited back without even having to pay it. It's pretty cool. Recovery startup businesses, there's a cap at $50,000. And this is, and I said this before, but this is like the most important part of today. The credit is a check that'll be refunded to you. They're behind. I think they're taking about 6 months to process right now. We saw some in 5 months. I think 6 is probably more accurate. Peter, do you know the count as of right now?
Last I heard was 3.8 million behind.
They're like trucking through all these payroll tax returns because these returns are amended, right? You've already filed your 941s for 2020 and 2021. You have to process it through an amended return. It takes a while, but you're going to get a check. It's not going to be a credit towards something in the future. There are no gold stars. It's an actual payment that you're going to get per quarter for the amount that you're eligible for. So it's really great in that way. That's like getting cash in the hands of business owners. Okay, so we're gonna start kind of getting into like things you can't do. We just explained all like the best case scenario, things you can't do. You can't double dip. So if you got PPP money and you can't get ERC money on top of that for the same dollar, same wages. So you can participate in both programs, but you can't use the same dollar twice. So if I pay Peter $30,000 in 2021, and I use $20,000 for PPP, I only have $10,000 left to use for ERC. And what we do, and I'm sure your professional, whoever's helping you all, would do the same thing. But what we do at the firm is we do this big work paper that basically shows where every dollar is spent for the entire eligibility period for payroll. So you'd see Peter's PPP money, you'd see Peter's ERC money for each of your employees. We do that. That way we can be absolutely sure we're not double counting anything. And if anyone ever comes back to it, we can show them our work paper to say like, this is the amount that we got. So, that's really important for your record keeping, because in 2 years, their IRS is going to ask you, how'd you get to a credit of $32,000? And you're going to say, well, my accountant did it for me, and like, who knows? So you want to make sure that you get that work paper. Very important. And similarly, like you can't double dip for like FFCRA if you guys use that program or any other government program. Essentially, like you can't, get a triple benefit on $1 paid, which makes sense. How to claim the credit. So I complain about this all the time. So it's claimed on that 941, the amended return. I hate 941s. The first time I filed one was for my nanny in 2014, and it was awful. Since then, they've made it 3 times as worse. It's now like 3 pages long. Every program that ever was is listed out on there, and you've got to explain exactly where wages are going and your calculations, and it's challenging. So this is the actual worksheet that goes with your ERC. Make sure you have this in your file as well as part of your analysis to determine how much you are eligible for. And I didn't say this before, so I'll say it now. In addition to all of this, this is like the how much. It's important to show that how you're eligible as well. What we do is we write an opinion letter. And like I said, we're tax attorneys. So an attorney is signing that letter saying you are eligible based on XYZ government order. You are restricted, and this is why. And this is for how long. And this is why you're eligible, pursuant to the CARES Act, pursuant to the Relief Act, et cetera. It's important that you have that information to show, where you got it from. But alas, anyway, this is the employee retention credit worksheet. You're going to have to use this one for each quarter that you're claiming eligibility. Okay.
All right, this is me. So what do you need to keep in your file? So for PPP, there really wasn't much out there. People were asking Rebecca and I, what's the bank going to ask for forgiveness? What do I need to have in my file? What documents? What do I need to create? And we were guessing and making best guesses, trying to figure out best practices. In this situation, Congress actually told the Treasury Secretary that he had to tell us. And so they did. And so if you are qualifying based on a full or partial shutdown, you need to go and find the government order. put it in your file. These things, there's not just one, they're renewed on subsequent occasions, tweaked a little bit, whatever it was, you've got to go out and you've got to find all those things. If you are qualifying based on reduction in gross receipts, you need to be able to substantiate it. And, you know, generally speaking, that's just a, you know, quarterly P&L, but better make sure your data was input correctly. And if you are accrual basis versus cash basis, you know, making sure that you're booking those entries correctly, because, you know, if you're close, you're going to want to be able to line out exactly how you got to the conclusion that you had that 50% reduction or the 20% reduction. You need to have records of qualified wages. For the most part, you know, pay stubs or, you know, something along those lines, pay reports. But if you get into a situation where you're considered a large employer and therefore could only qualify for the credit based on not providing services to the company, you're going to want to be able to show, you know, I was making this payment because they were providing service. I was making this payment because they weren't. One thing that I don't think we've mentioned yet is you can also include health plan expenses, which are basically the pre-tax premiums that you pay on behalf of an employee. That can also be used as a qualified wage. Rebecca mentioned tips, but this is another one that you can go and get. We'll get into it a little bit, but, you know, if you are considered a controlled group and therefore need to aggregate data across multiple entities, you're going to need to retain all the data related to those associated entities. Form 7200 was an advance payment of ERC that you could apply for, you know, even before you filed your 941. Probably not applicable. I don't know many people who tried to file that or got anywhere with it.
It was a nice, tried and were not successful.
It was a nice idea, but in practice, it didn't really amount to much. Copies of completed federal employment tax returns. You know, keep a copy of what you filed. Keep the documents for at least 5 years. There is an assessment statute that at least for some of the periods extends 5 years instead of the normal 3 years. So you're just going to want to keep this available if the government audited you, because certainly they could. So last couple slides are really the catch. This all sounds really good to be true, $26,000, you know, all this kind of stuff. There's some more details that if any of these apply, you're going to want to slow down. You're going to want to work with a professional, I think. So again, this is built on existing IRS law. So there's nothing new here, but there are ideas of controlled groups, meaning you have a similar ownership structure across various entities. You know, we have situations where, you know, a restaurant owner also has an interest in a manufacturing company or something along those lines. Those can be considered controlled groups. It can be parent subsidiary situations. It can be brother sisters. It can be combined groups. But if you have multiple owners and multiple interests owned, you're going to want to slow down and make sure that you don't have a controlled group. Controlled groups can be beneficial, right? You could have a situation where the qualification of one entity qualifies another entity that wouldn't otherwise be qualified, because if you're a controlled group, you're considered a single employer for all purposes of the employee retention credit. It can also be a bad thing, right? It could pop you above 100 or a 500 employee count and make the whole group ineligible. But the point is, slow down and work through the issues. There are also situations where a majority owner, based on family relationships, you know, if you have family members that are working for the business, they can be attributed, you know, basically majority owners and deemed owners, their wages don't count for ERC. You could also have situations where, because of a family relationship, an interest owned by a family member could be attributed to the business owner themselves. So really, these first two bullet points, if there are multiple you know, businesses owned, you're going to want to slow down. If you have family members working for the business, you're going to want to slow down too. If you acquired a business or a portion of a business, there are special rules and safe harbors for how to think about gross receipts in particular. So if that's happening, you're going to want to check into it. Sole proprietor income is not eligible for the employee retention credit, so this is different than PPP. If you are a sole proprietor and filing on a Schedule C, for PPP, everybody was asking you to, get your 2019 Schedule C and what was net business income on line 31 and all that. That's not what's going on here. That would not qualify for employee retention credit, and that makes sense, right? It's creating parity with the idea that a majority owner can't claim their wages as well. Much to Rebecca's chagrin, she can't claim the employee retention credit for her nanny. Household employers are not eligible. It's just a choice that Congress made. The assessment statute was expanded to 5 years in the American Rescue Plan. That covers quarters 3 of 2021 and quarter 4 of 2021. Otherwise, it's a 3-year statute. The refund claim was not extended, but you still have until April of 2024 to file these credits. But again, they're taking 6 months. We've heard of people a year and beyond. It seems like it's getting better. The numbers coming out of the IRS seem like they're getting better, but no time like the present. And last slide. Tax treatment of ERC. So again, this is existing tax code stuff. There's a code section called 280C. Basically says that if you get a credit based on wages paid, you need to reduce the amount of the wages deduction by the amount of the credit. So practically speaking, what this means is that you're going to need to go back and amend your 2020 tax return. And if you've already filed 2021 and it's not on extension, you're going to want to amend that as well. What it practically means is that you're going to change your business tax return to pass-through entity. You're going to have amended schedules K1 that are going to trickle down to the partners or to the shareholders, and they're going to have to amend their 1040. In and of itself, these amendments are easy, right? It's just one adjustment that needs to be made, and it should be pretty quick. But you're going to pay tax on it. That said, in almost all circumstances, it still makes more sense to claim the credit and pay the additional tax than not claim the credit at all, right? It's just a numbers game. This credit, as Rebecca explained, is refundable, but it sort of blows past the tax that is due and generates, hundreds of thousands. We've seen $1 million credits, rewarding employers essentially for keeping their folks employed during a pandemic.
But even if it's $20,000, so people are like, oh, it's only $20,000. Does this even make sense? It's like, well, if somebody came in and offered to buy you a burger for $20,000, wouldn't you do it? At what point? There is a point where it doesn't make sense, and it's way less than 20,000. I guess is my point. Just be thoughtful as far as what this is, and look at it realistically and whether or not it makes sense to kind of go forward. But that's it. Does anyone have any questions?
Didn't see any others. Last chance.
Last chance for questions on a tax credit. I know. Super exciting stuff. We try to make it interesting, but it really is just an amazing benefit to businesses that, were impacted by the pandemic. And just kind of one final thing about the restrictions, we've got clients that their gross receipts went up, but because of the restrictions, we're still eligible. So that's another kind of CPA trap that I found, is that people think that if your income went up, then you're completely disqualified, and that's not the case. So, all right. Well, that's it. Thank you so much, guys. We appreciate it.
Yeah, thank you guys. On behalf of What's Up, we thank Frost Law and Becca and Peter for doing a great job. And thanks to our sponsor, United Bank. And we'll see you all next time.
Thank you.